Money FM 89.3, the best of the afternoon update.
A very good afternoon to you. It's Lynn Lee with you on Industry Insight. The focus today is on Singapore's real estate market. And according to the latest data released by the Urban Redevelopment Authority, the office rental market in Singapore saw a second straight quarter of decline in Q4 2024, following a strong rebound in Q2 2024. Now, office rents in Singapore's central region fell 0.9% in the fourth quarter of last year, extending a 0.5% drop in the previous quarter. Despite the decline in the second half of 2024, office rents for the full year remained flat from the preceding 12 months when leasing rates had climbed 13.1%. Well, the URA also released statistics on the residential and retail property market for the fourth quarter of 2024. For more insights, we're joined by Dr. Chua Yang Liang, Head of Research and Consultancy for Southeast Asia at real estate company Jones Lang LaSalle. Welcome, Dr. Chua.
Hey, Lynn. Good afternoon. Thanks for inviting us.
Great to have you on the show. You know, Dr. Chua, we've been seeing a shift in the office markets, with landlords focusing more on maintaining occupancy than on rent growth. What do you think is driving this change, and what does it mean for the future?
I think it's quite fundamental. So here, investors or owners, especially those with a core strategy, would typically want to maintain income on their property. So simplistically, that means the income of properties generally is a product of rent and occupancy. So now asset managers will typically try to balance this relationship that is between rent and occupancy, depending on the underlying market conditions. Now, in this current market we're in, due to the cost consciousness of occupiers, there is kind of a cap on rental growth. Hence, asset managers and landlords, especially of lower grade assets, typically will give concessions to occupiers just to attract or retain tenants to maintain the income. And this is likely to continue, we think, in the near term.
Okay. We are also seeing the diverging performance of properties in the central business hubs and the secondary areas, right? So do you think this trend is set to continue this year?
Yeah, but let me explain a little bit of the data because this information is quite vast. So, firstly, the URA has two sets of information here on median rents. One is based on lease commencements, and the other is contract date for both Cat 1, that is higher quality, modern assets that typically have larger floor plates, GFA, and are located in the downtown, and Cat 2, which are all other assets over the island. So I'm looking at those under lease commencements, and based on that data, the rental gap between Category 1, that is the better grade assets in the CBD downtown area, and against all others, the gap has peaked somewhere about 2021 in the fourth quarter, just after COVID, about 550. That means the gap between good class and lower assets, the gap is 550, and that has been narrowing since 2022. Now, this recent bifurcation trend, that is where Category 1, the good assets, versus the not-so-good ones, the Cat 2, has been falling, reflects the underlying market weakness that I just mentioned earlier. So as mentioned before, it is due to the cost consciousness of occupiers brought forth by the geopolitical and economic uncertainties. Now, this bifurcation trend has certainly affected landlords of lower-grade assets, and it's motivated them to undertake improvement works. At the same time, tenants have also capitalized on these narrowing gap to upgrade to better quality buildings. That is a flight to quality that we so much read about and heard about. Now, we expect this downward pressure to remain for Cat 2 assets and further motivate them to upgrade or value add or even undergo a complete redevelopment or change of use.
Okay, but what's behind this trend with businesses seeking higher quality office spaces?
Right. So the motivation is twofold. First, one is driven by CSR, the corporate social responsibility. So firms are now able to offer better quality spaces for their staff. It also serves to attract new employees and retain or even motivate existing ones to return to the office. Now, the other reason is quite pure economics, really. There is value proposition for the company. So firstly, some businesses were right-sizing during this period, especially with hybrid working and all. And with that, they could now move to better quality buildings with the same budget.
I see.
Now, such flight to quality behavior is common, especially in a weak market when occupiers capitalize on the opportunities to upgrade. And again, in this current market, I think the risk still remains for owners of Cat 2 buildings. Firstly, cost consciousness is putting a lid on how much rents can expand, especially on Cat 1 assets. Secondly, the growth for Cat 2 over the post-COVID period, that is between 2021 to 2022, has been much faster than Category 1. But so in this current market, where the pressure is on for Cat 2 buildings to continue to adjust downwards, because by pure nature, the quality of buildings are a little bit weaker.
Okay. Dr. Chua, what's the outlook for this, for Grade A office space in Singapore?
Well, based on, we usually look at the underlying economic conditions of the office is a derived demand. Real estate is all a derived demand, right? So the government's forecast for GDP for Singapore is a tad weaker in 2025 as compared to 2024, just about 1 to 3%. Now, most market watchers agree that the growth would be stronger towards the second half of the year because of potential policy changes associated with the Trump administration, and that will become clearer by that time. And the sustained economic growth should also fuel business expansion then. They should motivate tenants who have previously postponed their relocation or expansion plans to re-enter the market. And we think that the ongoing flight to quality trends and the greater emphasis on return to office will further add more office demand. Now, with these factors combined, we expect with the low interest rate and the limited new relocation options available, it should support the office rental and capital values in the second half of 2025. In other words, first half is going to be stable. The second half, we're going to see some growth.
Okay. Now, turning to the residential market now, according to the URA stats, the latest ones, we're seeing some strong numbers in new home sales in the fourth quarter of 2024. So based on that data, what do you make of the numbers? Have there been any surprises or shifts in buyer sentiment?
No, I think generally speaking, the market there is some buoyancy right now, given where in the first half of this year, economic conditions have improved. And definitely with some of the rate cuts happening in the market, occupiers or the investors and buyers have been more resilient and come back into the market, especially if you look at how HDB upgraded this market as well. They supported some of the upgrading buying they've seen in the market. So there are no surprises. I think the concern, of course, in the market is everybody's talking whether there be more policy, there could be a lash upon the market as a result of this buoyancy. So it's something that we have to watch very carefully over the next few quarters. I think the minister himself has already indicated he's looking at possibilities is out there, but let's see what happens.
Okay, with the current supply pipeline, are there concerns about an oversupply in certain segments of this residential market? How do you foresee the balance between supply and demand evolving in the coming year?
I think there is a fair bit of balancing here. In the long term, I think if we go by where the market is heading and where our long-term growth for Singapore, I think it's in a good shape right now.
And talking about retail as well, how did the retail sector perform in Q4 2024 compared to the same period last year?
Right, I think overall retail has also stabilized. I think if we look at, there's no new supply market that we are seeing in the market, rather, no new supply retail in the market. By and large, the occupiers, the tenants have been more resilient because of our improvement in terms of the tourism number. So overall, vacancy has tightened in the retail space, and that's lent some support to the rental market. In terms of the capital investments, generally retail is one of the few asset classes where there is still a decent gap in terms of a gap between interest rates and yields, so where it's still positive carry for investors. So there is a return of investor interest in this sector, and there are plenty of assets that are now undergoing AI. So I think in terms of the mid to longer term, I think there is some opportunities to be had for some of the assets we are seeing.
Okay, but with e-commerce continuing to grow, how are traditional retail spaces adapting to integrate online and offline experiences? Do you foresee more hybrid models becoming common? I
think we cannot deny the fact that e-commerce is here to stay, right? I think Singapore's e-commerce has maintained about over 24% of our overall retail sales, and that's fairly healthy. It's comparable to what you're seeing in mature markets like the US. So I think we have probably come to a point where it's kind of maintaining now, which means what you're seeing right now in the market, where you have seen e-commerce taking brick and mortar shops And likewise, some brick-and-mortar shops definitely going to e-commerce. That kind of balancing is here to stay. I think what is important is for occupiers to continue to maintain the experiential element in their shops, be it visual, be it actual physical entertainment for them, or even visual kind of experience for the occupiers. You see that a lot in strong brands, in the luxury brands. You'll find that the emphasis is all about the visual reception. When you first see the store from afar, you kind of being drawn into it. That kind of experience carries through into the mall itself. And I think that's important for retailers today. Likewise, for the investors and owners of malls, we need to continue to offer that opportunities for big brands and even small brands to offer that kind of visibility to the shoppers, to bring them into the shops and bring them into the mall. And most shoppers are using opportunities to test bid, to check out the merchandises before they buy online. So that relationship continues and will continue in the future.
All right, before we let you go, Dr. Chua, looking ahead into 2025, since we are at the start of the year, what are your key predictions for perhaps first the office and then residential and retail markets in Singapore? Do you expect more stability, or are there potential risks on the horizon?
I think the first half of the year probably presents itself as a little more risk depending on where policies are globally, especially from the U.S. in terms of U.S. economic policies, as well as geopolitics. So I think the market is likely, that means office, residential, retail, all that, because it's derived demand, will feel some of that downside pressure. Maybe less so for residential because there's a lot more domestic demand, and that depends very much on how internal policies are, the domestic government policies as far as residential is concerned. The second half presents itself a little bit more optimistic because we think that economic conditions globally should have a stronger lift once you see the Trump policies are clearer, continual economic growth will sustain some of the consumption. So office is likely to see some pickup back then. Retail, I think usually the first half is typically there's a lot of holidays, a lot of outflow of spending outside of Singapore. I think second half you expect some return of tourism to lift the consumption here. As far as residential, I think it's really a policy game right now, depending very much on where the government stands as far as that's concerned. But by and large, I think the fundamentals are strong for all the three sectors.
Wonderful. Always a pleasure to have you on our show and listen to your insights, Dr. Chua. Thank you so much.
Anytime.
Dr. Chua Yang Liang, Head of Research and Consultancy for Southeast Asia at real estate company JLL.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.